everyone. This is Abhijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of May 5th, recording this on Sunday, May 11th. We know that this was the week of the FOMC meeting. It happened on May 6th and 7th. Today, we'll share what Jeffrey Gundlach, the Chief Investment Officer of DoubleLine Capital, said after the meeting. It's very customary in CNBC. Scott Wapner, also called the judge, brings over Jeffrey Gundlach after every Fed meeting and has him share his thoughts about the economy, about the market, about just the broader central bank policy. So we'll talk about what Jeffrey Gundlach said. We will look at the US-China trade negotiation that happened over the weekend. We know that it was a Saturday and Sunday event in Switzerland, Geneva. We just turned out, as we saw on CNN and other news media, that Scott Bessent came and said that it was a reasonably positive meeting. They think they have a deal. They didn't quite announce what the deal was, but they expect to announce tomorrow, Monday. But we'll see, that Bitcoin trades 24/7. We'll see what the Bitcoin chart is telling us. We look at S&P 500, and in particular, there are many that think S&P 500 has reached to a key resistance level, somewhere near its flat 200-day moving average, and likely will head back a lot lower. In fact, even Jeffrey Gundlach said he's raised a lot of cash. He's waiting for, it's in a risk-off mode is what he considers the market, and he's waiting for a potential 4,500 handle on the S&P 500 before he starts inching into the market. But we disagree. We feel that the market is setting up for significant breakout. We feel that, yes, near term, this is a lot similar to the V-shaped move that we got in August. Into August to late August, early September, we got a pullback. We expect a similar kind of pullback, a shallow pullback, 3 to 5% on S&P. And then we expect the breakout, and we expect the breakout to take S&P back to challenge its old highs from February at 61.47 and then break even a lot higher. That's what our thoughts are. We'll share why. And a couple of key industries, we'll end with that, have been extremely strong. We'll show you software industry has done really well in this recovery from the April 7th low. We'll show you a couple of leading stocks in the software industry. And then we'll also show you specialty retail. That has also done extremely well. And a very popular pet-based retailer, CHWY, will show its chart and why we think it's headed for more upside. So with that, let's just get right into our blog site. It's at chartsarefun.substack.com. We appreciate you subscribing to it. Just share your email and you'll get the blog as soon as it gets published, typically in the morning around 7 a.m. Also, our YouTube site is called Chartsarefun, youtube.com/Chartsarefun. Appreciate you subscribing to our channel. And then if you like the videos, if you could hit the like button, we really, really appreciate that. As we know, our insights are really all related to charts. This is more of a technical site, a technical video for those that are not as well versed in technical patterns. Our goal here is to simplify it, show it to you, explain it to you why we think these are interesting insights that can guide you in your investment decisions. There's no guarantees in the stock market. Anything can change with news, with fundamental and catalyst that in the geopolitical environment that we constantly is coming out and we know has been impacting the market. But the trends and the key patterns do have a guidance. We believe they are kind of a guiding light for our investment decisions, and we actively use it for our own investment decisions. Though we are not an investment professional, our goal here is not to give you investment advice. So we appreciate you just taking this with the insights in mind and then use it to your best discretion. We're going to go straight right into Jeffrey Gundlach's interview with Scott Wapner. And he kind of reiterated that the key message of Chair Powell's press conference was a lot of uncertainty. He brought on a very interesting statement. He did not want to say the bad word of stagflation, but he brought on in the press or in the FOMC minutes, or not minutes, but the press release, that they see now heightened risks of unemployment going higher, as well as concerns of the inflation coming out, increasing because of the tariff concerns. So that in many ways, the fact that the unemployment could go higher, which is one of their mandates is to maintain price stability with respect to inflation and full employment with respect to the jobs. So the fact that they expect unemployment to tick higher indicates economy slowdown, the stack part of the stagflation. And the fact that they're concerned about higher prices indicates the inflation of the stagflation of the inflationary concerns. And that's not good at all. When the economy goes into a stagflation with a stagnant economy, kind of pullback in the GDP and kind of economy struggling with higher inflation, it impacts the consumers, it impacts the businesses hugely, right? So Jeffrey Gundlach talked about that Chair Powell was extremely cautious, not knowing on which part of the mandate would he act on with respect to further rate cuts, or if he had to raise rates because of inflationary concerns. He just said there's too early to know. We do not know. Very uncertain with the tariff policies. Things do change a lot. You have a certain tariff and then it gets brought down or it's kind of pushed back out and so on. And Jeffrey Gundlach feels that the FOMC rightfully is cautious. He is just as cautious himself. He talked about in the current environment, he believes the market is in a risk-off mode. He is concerned that the long-term yields will shoot up. He does feel that we are in a phase where the yield curve steepening has kicked off in full gear, and that yield curve steepening, his perspective would reel from long-term treasury yields increasing versus the short-term treasury yields kind of staying where they are, or if there are any cuts kind of coming down some. But the widening or the steepening of the yield from his concern is with long-term yields going higher. He is, as a result, cautious on the bond market. He's also cautious on going long on the long-term treasuries. He is being cash preserving as a result, maintaining it in cash. And he's waiting for an opportune moment. And right here in this YouTube video, we'll share the link of that. You can see his support band in the S&P is 4,500 to 4,600. That's what he stated. That's his approach where he sees the market headed. That said, we know that the US officials were there. Scott Bessent and Greer were there, our trade guy at our trade secretary at the Geneva, Switzerland for the China trade talks. And turned out they came out of it after 2 days of talk and said there was substantial progress and some sort of a deal, but they said the deal would be announced on Monday. They probably are concerned about market movements and so on, have to vet it out with President Trump after they head back. And maybe that's when they'll probably have President Trump announce what the deal is. And we can perhaps expect President Xi, from the China Premier Xi to kind of come out with some kind of a statement as well on the Chinese front. But Bitcoin, we know, trades 24/7. And we know that in anticipation of the China deal, there was a very big breakout in Bitcoin. It had, of course, been positive trending since that low on 74.4K on April 7th, had kind of come up to towards the 85, 86 level, kind of formed a nice consolidation pattern or a flag pattern, broke out higher towards the April 21st timeframe. From there, again, another consolidation. And then this Thursday, we got that other big breakout from near the high 90s, the 97, up towards the 102, 103,000. Yesterday on Saturday, it went up to 105. Right now, it's trading right below 104 at 103,993. It trades 24/7. So we'll see when the market opens tomorrow where it trades. We do believe that this Bitcoin chart is setting up for what we call as an inverse head and shoulder. We believe that the neckline is around the 108, 109,000. That's where we think Bitcoin is headed near term. From there, we expect a pullback, some form of a right shoulder pullback to how we had this left shoulder form in the December to the early February timeframe from 108, 109 to the 90,000. So we expect a pullback, and we can see this is a beautiful W-shaped double bottom, the 76.6, 74.4. As that happened, we can see beautiful positive divergence. RSI at a higher low while the second low got tested. Same thing with MACD at a higher low when the second low near 75, 74 got tested. So this beautiful W-shaped double bottom broke out of that, testing key resistance at 109. That pullback would perhaps come towards the tip of the W around 88.8, 89,000. It's also near where the rising the 200 and the 50-day moving averages are. The 200-day moving average is at 91,000. The 50 days around 89,000. So we could expect a pullback here, the right shoulder, and then a breakout. And when we do get the breakout from a 74 to a 109, that's roughly, you're talking about 35,000. At 35 to 109, we're talking about 144,000. We've been talking about Bitcoin in the last few videos about a target near 145, 150,000. We wouldn't be surprised to see it break above that 144 target and get closer to 150 or even slightly higher. We can see beautifully overbought RSI showing indication of momentum on this break higher. So that RSI getting up a lot of strength at 73 right now. And we believe that this is looking very bullish for the crypto buyers, for the crypto longs. Now, from there, moving into S&P 500, we see that it kind of stopped right at the flattening 200-day moving average, which bears are declaring victory, saying this is it. This is now setting up for a big next year or the next leg lower. And the bears are looking for the break of the 48.35 bottom from April 7th and go to lower lows. Even Jeffrey Gundlach talked about 4,500 as where he sees the S&P 500 kind of settle down from the lower move from these levels. We are not as bearish. We feel, if any, this is setting up for an inverse head and shoulder as well. The neckline is around that 5,700 or so. We expect, just like we saw this pullback in late March from that 5,700 towards the 5,490, 5,500 level. We think that's where the S&P 500 could pull back. A very similar environment, because this V-shaped move that we saw is what we saw in the V-shaped move in the August 5th. Remember the Japanese stock market crash? That was on August 5th. That was when the carry trade collapse in the market happened. We see a beautiful V-shaped recovery from that 51.19 to the 56.51. Few days of consolidation, and then going into early September, we got a shallow pullback. Where did the pullback end? Pullback ended right at the previous support level at 53.90, 54.02. In a similar way, where we think the pullback ends, we think it pullback ends at that late March level, around that 54.90 level. That's where we think the pullback ends, similar to what happened in August. Same thing in August. Look at how MACD turned lower. So after the initial V-shaped climb came, MACD climbed. Then MACD kind of dipped below zero for a short period, for 3 or 4 days, formed a beautiful bell shape. I love the bell shapes on MACD, and that's why I very closely follow for market movements. Whenever you see the bell shape kind of curve out on the top, that's when an intermediate term top happens or a short term top happens. Then when it curves out on the bottom, a short term bottom happens, and on and on and on. So right now, we just had a bell shape that kind of topped out, has begun to decline. That's where we believe the momentum. Market is holding out there in that 5650 to 5700 level, but we believe that because the MACD started to decline, we are in the process of what happened right here in that early September timeframe. We believe a similar setup is happening where we get a pullback next week, the next 2 weeks, by the options expiration, get that pullback towards the level here at 54.90, and then from there, a beautiful right shoulder of an inverse head and shoulder and a breakout higher. 48.35 to a 57.20, you're talking about 700 points roughly, little less than 700, maybe 685 points. Add that to 57.20. So that takes us to like 6,400, 6,420, subtract 15, 6,405. That's where we think the S&P could move out, break out above the 6147, go towards the 6,400. Before that, though, this MACD has begun to curve, and we expect that pullback, like we saw in the late August into September, happening. There are other indicators that indicate why the pullback is coming. Look at what happened in the August timeframe into September. Look at how in the V-shaped move, the McClellan oscillator for the New York Stock Exchange indicates market breadth had gone from minus 69 to plus 59, and then it fell. It fell for 2 to 3 weeks to the minus 43 and then started climbing. See how the MACD curved. Same idea of the S&P 500. MACD just is great indicators of turning points. So MACD beautifully formed a bell shape, peaked out, came below the center zero line, beautifully traced out another bell shape below the zero line and then started climbing. And when it started climbing is when S&P started climbing. We are kind of at the middle of that. We have kind of this MACD on the histogram on the top of the zero line is already completed. We are already below it. But I expect in the next few days, a pretty quick move down of the MACD at a higher low. We don't expect MACD to go too much lower. At a higher low, maybe in the minus 30 to minus 40, we see it has tested multiple times, minus 45, minus 43. So something in that minus 40 level is where we expect the McClellan oscillator to come down to, while the MACD then beautifully carves out a bell shape kind of below the zero line and then starts climbing. When that starts climbing is when we think the market is going to recover, break above that neckline at 57.20 and climb a lot higher. Another indicator is the percent of S&P 500 stocks that are above the 20-day moving average. Look at how that had climbed from somewhere around the 20% level to the 92, 93% in the late August timeframe. And then in a couple of weeks from there, sharply came down towards the 45 to towards the 30 level and then climbed. In a similar way, we can see that the percent of stocks above the 20-day is now peaked out at 88. We closed at 77. The MACD of that has also begun to curve and head lower. We believe that in the next few days, next week and the week after, we're going to see this come down as well. Come down potentially towards the 40s level as well. We can see that it has tested 40s multiple times towards the 40s level, maybe right at the 50-day moving average at 44, and from there start climbing. So as the percent of stocks above the 20-day moving average starts coming down, that indicates market breadth deteriorating. It indicates market pullback. It indicates a market coming down lower. So we believe from the McClellan oscillator, from the percent of stocks above the 20-day moving average, and finally, a key indicator market sentiment is put-call ratio. And there are many put-call ratios. This in particular called CPCE is the CBOE stock, the options exchange, their put-call ratio for equities. Equities are basically not indexes. These are not like the NASDAQ index or the S&P 500. These are equities such as the respective stocks that are out there that are trading in the various exchanges that are in the options market. You can see a beautiful higher low pattern in the put-call ratio. Whenever you see spikes in the put-call ratio, those are usually when the market bottoms. We can see that the last spike we saw was right before April 7th, market bottom right there. The other one happened towards the August 5th timeframe. That's when the market bottomed from the Japanese stock market crash. We had another spike here in the September 9th timeframe. That's when the pullback ended, and then the market started climbing. So we believe that with these higher low patterns in the CBOE put-call ratio, we're about to get a spike higher. That spike higher will also lead to a spike higher in VIX. We're not showing the VIX chart here, but we can see that the MACD on this put-call ratio is also beautifully carved out a bell shape under the zero line, time for it to go above the zero line. So for the next few days, we can expect the MACD of the histogram to go above the zero line, MACD on this to climb as the CBOE put-call ratio begins to climb from these pattern of higher lows. So that's the other thing that we're kind of feeling that this indicates that potentially we are looking for a market pullback. Now, why are we confident that the market is only going to have a shallow pullback and not break down like Gundlach and the other bears are thinking is because of this intermediate term market indicator called the New York Stock Exchange Summation Index. This is a cumulative market breadth indicator in terms of advancers minus decliners. This monotonically tends to rise when the market climbs for multiple weeks. Each candle here, we're looking at a weekly chart. Each candle here is a weekly move. So typically it goes from minus 1100 to the plus 1100. That's a cycle of how it moves back and forth. We have been forming a pattern of higher lows. We saw that in the 2022 October, we had minus 1138, minus 834 in the 23 October bottom, and the recent bottom on April 7th is hit minus 590. So it's a pattern of higher lows, indicating the market is not bearish as many people think. If any, it's going to continue in its climb higher. It's still in a bullish phase. So we believe that this potentially climbs back to the 1100 level is when we think we would get start getting cautious. That's what we're watching. We're watching the summation index to continue the climb. When it climbs, it continues in a monotonic way for several consecutive weeks. So here we can count 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks it climbed. So far, we've only climbed for 4 weeks. We've got another 5 to 6 weeks of climb left. That's why we believe that start thinking about the market where we are now, which we are towards early part of May. This is not going to be a sell in May as many in the adage think about. This, if any, markets got more upside into May, into the next 5 to 6 weeks, which we are talking about into the late June timeframe, even early July, is where we think this summation index will go towards 1100. That's when a true overbought from an intermediate term will happen in the market, and that's when we will start becoming cautious on the market. A beautiful positive divergence when a lower low in the summation index happened. You can see that the RSI was at a higher low. That also indicates that this is a climb that climbs higher highs. And we can already see summation index has taken out the previous climb that we got in February. Remember, market peaked in February. It's already crossed that, which means the market's breadth indicator is already better than what was in February, now headed towards December, but we believe it's going to climb back to what we saw in late September, early October, towards that 1100. So we are bullish. We, as a result, go back to the S&P 500 chart and explain that we think this is a beautiful inverse head and shoulder. The neckline around that 5700, the 200 are moving 5720, 5750. Right shoulder move towards the 55, 5490, 5500, 5490. Breakout headed to 6400. That's just where we see the markets headed. And any pullback that we get in the next couple of weeks would be an amazing buying opportunity. I said I'm going to talk about the various industrial sectors. There are a total of 11 sectors, starting with, and we are seeing year-to-date gains or losses mapped out in these sectors. And in each sectors, there are several different industries that compose the sector. So communication services is about media agencies, broadcasting, entertainment, fixed line telecommunication, internet, publishing, mobile telecommunication. Fixed line is the Verizons, the folks that provide the fixed lines to our homes. The mobile telecommunications are, of course, the T-Mobile, the ones that AT&T, the ones that provide large wireless connections onto our houses. So far, year to date, only 2 industries in the communication service are green. The biggest one is the fixed line, and guess why? Because this has so far been a defensive start to the year. Fixed lines are defensive stocks. They are the stocks that do very well with paying dividends. Money flocked into it, and so far it's up 21%. Verizon, the AT&Ts, those companies have been doing great. Is why the fixed line is showing the strongest growth in this sector. And the next is the mobile telecommunication. Again, cash flow generators seem to be pretty steady, independent of tariffs, and as a result, they've been doing well. Media agencies got hit. There's been concerns with the tariffs, and and so did the internets. Media got hit worse, and then the internets got hit 10%. Consumer discretionary, you can see there are many industries that composes that. One of the good ones that has done really well is the specialty retailers. And that's what we see, the chart of the specialty retailers. You can see this climbing higher highs. And this look at this chart doesn't show you any indication of what happened to the market. It's already at a higher high from what we saw from February. So that shows the strength. That shows how this industry, though it had pulled back sharply towards the April 7th low, look at how sharp of a V it is. S&P 500 has not been able to scale its February high, but consumer discretionary specialty retail, that's what the DJUSRS is. Specialty retail is already at a higher high above the February high. That shows market strength. Here we are highlighting the fixed telecom, and the fixed telecom we notice is, though it's up 21% year to date, it's still right now, because it's significantly higher than where it opened in January, it still has not quite been able to even take out the late March high. So go through every sector. Staples, we can see the strongest one is the drug retailers. They've been doing really well. And tobacco, again, a defensive industry. People smoke independent of tariffs or not. Tobacco turns out to be, and again, a very defensive sector, tends to be value sector, tends to be where people flock for dividends. And that's been doing very well, up 32% for the year. And you can see this tobacco industry chart climbing higher highs, all-time highs, way above the February, March high is broken out, and from that April 7th, a beautiful, very sharp rally in the tobacco sector, or tobacco industry in the staples sector. Energy has been overall poorly performing. We know the oil has hit $60 a barrel and lower. Across the board, we can see negative prints on all the various oil equipment, integrated oil and gas, exploration, pipeline, coal are all negative so far for year to date. Financials in particular that has been extremely strong is the full line insurance. Those have been really doing well. And then the others like the specialty finance have been doing well as well. Healthcare, we know, has been tremendously hit. Particular, if you look at healthcare providers, United Health, biotechs have been badly hit, and so have been the pharma. So these three are negative, but what is holding strong is medical supplies and medical equipment are doing reasonably well. And medical supply, we can see, is right now testing its late November, early December high, and that's where the medical supply industry is. On the industrial sector, the strongest is actually aerospace. We can just see here in the aerospace up 17.49% year to date, and we can map the aerospace has taken out its late March, mid-February high at a higher high. So that's by far one of very strong industries. Look at how very sharp recovery from the mid-April to how it has come up this far. So aerospace, of course, there is Boeing has recovered. The deal made with UK last week. There's discussions of about 10 billion of purchases of Boeing aircrafts, and India now with the war in Pakistan might be investing into fighter aircrafts as well. So the overall aerospace industry has been doing extremely well, up over 17.5% year to date. Materials, we know that the biggest movement there is in precious metals. No wonder gold mining is up 52%. However, we are very cautious on gold. We talked about it before. We're not going to touch today. We think gold's headed higher, so just to be careful. Real estate is a defensive sector. Because mortgage rates, long-term interest rates are higher, it's got impacted this a lot of negative in the REITs and the real estate sector. The only two holding up is the diversified REITs and the mortgage REITs that's slightly at plus 1.35, and specialty REITs. Technology, we know, has got hammered because of tariff concerns across the board. But one shining star, not so much year to date, it's only 2%, 1.94, is the software industry. And we can see the software industry, look at its sharp recovery of the April low, almost on the verge, gapped higher in last week. And from that gap higher has been kind of climbing very close to testing its February high. We'll take a little deeper dive on the software sector next. And utilities, we can see, is a defensive sector, has been doing extremely well across the four areas: gas distribution, multi-utility, conventional, and water, all positive year to date for the year. So as a defensive sector, no wonder has done very well. So let's hone down on the software sector. This is a beautiful gap breakout around that 6,900. 6,900 was key resistance that it broke out, leaving a gap. That breakout higher from 57 to 69, you're talking about 1,200 points. At 1,200 points to 69, it's 8,100. So we are right now near 7,500, 7,410. So 8,100 is still 700 points higher. And 700 points means you're talking about a little less than 10% additional move in the software sector. We are very bullish on this industry, and a couple of key leaders. You can go map out in stock charts if you have the membership to look at all the various components of that software sector in this particular case. And in this case, we can see that if we do by scooter, sorted by scooter, the scooter is the relative industry strength. In that industry, what are the strongest stocks in that sector? And it's a stock charts technical ranking is what scooter stands for. Highest is Palantir, and we look at Palantir shortly. Second one is a big multi-language translation software maker, Duolingo. Those two are by far the strongest stocks. Look at Palantir's chart. What a parabolic move from the 13-15 level in the 24-23 timeframe has climbed to 125, a factor of 10x. Pull back sharply to 66 during this tariff-related sell-off. Back recovered, it's 125 high. We believe this is setting up as a cup and handle. It breaks 125 from this cup, from 66 to 125. You're talking about 59 points. At 59 to 125, you're talking about 184. That's where we think Palantir is going to be headed. This pullback, look at the reversal tail, a long tail. This came from its earnings early last week. Didn't matter. It recovered from the earnings, made up for most of the losses when it had come down lower after the earnings and recovered it. And now I think if the market after the pullback in the next couple of weeks starts taking off, S&P breaks 57 and 100 and goes towards our 6,400 target, Palantir heads to 183 or 184. So we are very, very bullish on Palantir. Duolingo, however, is a bit more of a concern because of the negative divergence that we're seeing as it is gaining higher highs. We can see that the low at 60 to 245, that's we can see a kind of a nice base, a cup and handle kind of a pattern, a cup between 204 to 60 to 245. So that's 185 added to 245. That's roughly, 430. It already took out 430, it hit 441. Pull back to test that rising 50-week moving average, and from there it's climbed to higher highs. However, as it's climbing higher highs, MACD is at a lower high, so is RSI. So we are not as bullish on Duolingo. We believe most of its run is kind of done, and we would be cautious and not expecting much more upside from Duolingo. Another industry that has done extremely well is specialty retail. I talked about that. Look at its sharp move from 3,400 to 4,400, 1,000 points in a span of 4 weeks. While S&P has climbed 17%, you're talking about 1,000 points out of 3,400. That's over 32% climb. That's what it managed to do, or 30% climb that it managed to do in the span of the 4 weeks. That climb is a bit of a topping because of the lower highs in RSI. That's kind of a negative divergence. That said, if you look at the pattern of 3,200 to 1,600 to 3,200 and then the break, that 16 to 32 is 1,600 points. Add 1,600 points to 32, it's 4,800. We're right now at 4,335. So we believe there is some more upside. 4,800 is where the specialty retailer is going to go, which means that this RSI, by the time it prints 4,800, might be at a lower high, and that could indicate a top. But near term, we believe that there is some upside. And a key way to look at all the various components of that specialty retailer is here. Let's just sort it by scooter again. ThreadUp, National Vision, CHWY is number 3, scooter of 95.2. So let's look at CHWY's chart. CHWY in its weekly chart is formed a beautiful inverse head and shoulder. The neckline is right at 40. It tested 40 here in 2023 around the June timeframe. Pull back to 14, up to 40. So 14 to 40, you're talking about roughly 26 points. At 26 to 40, that's 66. Beautiful inverse head and shoulder. We can see that the left shoulder is at 29, the right shoulder is at 29, neckline at 40. So neckline at 40, left shoulder at 29, head at 14, back to 40, right shoulder at 29. That breakout is just on the verge of breakout of above 40. Next couple of weeks, we expect this breakout. It goes from 40 all the way up to 66. That's a reasonably good upside. 26 out of 40, that's kind of 60% kind of a move in CHWY. Fundamentals seem to be strong. The stock seems to be picking up momentum. And look at the huge volume when it recovered in the out of the base in the 14 level up to 39 in that summer timeframe of 2024. So this is a bullish stock for those that are looking at individual stock investment opportunities. CHWY seems, and those are pet lovers. We order a lot of our products from CHWY, extremely well geared and up for a massive upswing in the stock. So with that, to sum it up, Jeffrey Gundlach talked about cautiousness of the market. He believes that Chair Powell was extremely uncertain about everything, keeps saying too early to know. We don't know about where the risks are, whether it's towards the economy weakening or towards higher inflation. Jeffrey Gundlach himself is cautious, feels that this is a risk-off environment. He thinks S&P is around 4,500 target. He's hence sitting on cash, waiting for a pullback before he pulls his money into the market. The China-US meeting went well, the trade talks. There's going to be some sort of a deal announced tomorrow. We'll see if that does to the Bitcoin. Right now, it's hovering a little negative, right below 105, but we think it could kind of go up a little more towards the 108, 109. And from there, the Bitcoin could see a pullback towards the 90 to 89,000. That would be an amazing buying opportunity because we believe then it's an inverse head and shoulder, Bitcoin breaking 109, going towards the 145, 150,000. So you get a chance for those that are not long in Bitcoin. If it pulls back towards 89, 90, consider buying ETFs, the GBTC, the IBIT. These are the various Grayscale or the Fidelity. FBIT is Fidelity's. IBIT is iShares Bitcoin ETF. Consider doing that. Or for those that are more aggressive into Bitcoin, there's a 2x ETF called BITX that also pays a monthly dividend, and that's a great way to play the further upside in Bitcoin that we see here. S&P, we believe, is also forming a beautiful inverse head and shoulder. This is the right kind of a neckline pullback coming. The reason we feel convinced about the pullback is because of the oscillator, the McClellan oscillator. Already MACDs dipped below zero, some more downside in the oscillator, some more downside in the percent of stocks in the 20-day moving average, and in the put call ratio climbing, indicating more puts, more fear in the market, and market pullback. And with that, the reason we believe that we are not going to pull back too deep, a shallow pullback and continue the climb is this intermediate term view of the summation index. It's just started a climb for 4 weeks. As we've seen in the past, monotonically climbs for 9 to 10 weeks. We got at least 5 to 6 more weeks of climb left in this summation index, which would take the market much higher towards the 6,400 level. With that, good luck investing. We'll talk to you next week. Thank you for listening.